Welcome to our business webinar program presented by Bank of America. Today's session is how debt can work for you, and we will be learning how to prepare for using debt products like bank loans, how to choose the right products for your business goals, some info on avoiding predatory lenders, and how best to plan for repayment. I'm Desiree Brown, Senior Manager of Digital Education and Content here at the Tory Burch Foundation. I am so excited to be here with Dorothy Kolb today. Dorothy has worked with the foundation for a few years, and this is the first time that we're having her in the webinar series. She's the founder and CEO of DK East Associates, and she specializes in fractional CFO services. So Dorothy has a lot to tell us all about debt and what that looks like, how that can work for your business. We're in very good hands today. So after her presentation, we will have plenty of time for Q&A. So we invite you to ask your questions in the Q&A box and to use the chat function for community building, answering any questions that Dorothy may throw out. And we invite you, of course, to take notes. Today's session will be recorded, so please watch your inboxes for the replay link, but it's always great to have that information live as you're here with us today. And with that, Dorothy, over to you.
Hi, thanks, Desiree. Hello, everyone. And if you're on the East Coast, it's cold. If you're on the West Coast, it's probably not. But I'm super glad to be here with you guys today. And I'm going to just go over relatively high level on debt. We're going to get into it a little bit. I'm not very, very high level, but I'm not going to get into all the minutia of it, but give you an idea of, what is available for you, what makes sense possibly for you to look into at this point in your business. And then, of course, at the end, we'll have questions and super cold on the West. Oh, no. We'll have questions and we can address, any of the questions that come up more broadly across everyone. So I'm going to go ahead and share and get started. Whoops. And I will present. And hopefully my cat will not walk across my desk. So can't make any promises there. All right, so business debt, what should you consider? Just wanted to briefly go over what kinds of funding and financing there is for your business. We won't get into these first three in this particular workshop, but I just want to make you guys aware of it. Most of you might already be bootstrapping, which, as you know, means you are funding it yourself from your own personal savings. That's the way I started my business. Kind of more famously, there is a woman that started Luminary, and that's now a multi-million dollar business in New York that she started and still has done bootstrapping and has no investors or debt. So it can be done. Of course, equity raises are when you're ready at a point when you are generating a good amount of revenue, your projections are going to be generating more revenue. You might want to consider bringing investors in, especially if you are a product-based business and you need a little funding to get inventory going and things like that. But just keep in mind that when you have an equity raise, that means you now have a boss, because now you have people who are owners in your business and they're going to require certain reporting, decision-making, things like that. So just keep that in mind. Grants, of course, grants are wonderful because you don't need to pay them back. However, on the upfront side of it, there is a lot of work in grant applications. You need to be very specific, but they are out there and they're often looking for women and women of color in order to, disperse grant funding that they have, grant dollars that they have. So definitely look into that. And then finally, debt, which is what this workshop is about today. And debt, of course, is when you borrow and you need to pay it back. That can be credit cards or loans, any kind of debt that you need to pay back at some time. So what kinds of small business debt are there? I mentioned credit cards. That's usually the first one that people open up. There are small business loans through banks. There's SBA, the Small Business Administration, which has certain loans that are at a very low interest rate for a long period of time. And I will discuss each of these in more depth in a second. Lines of credit, which are there when you probably don't need it, is when you should apply. It's there. You can use only the portion that you need to and then pay it back. Microloans are between $5,000 and $50,000. Those are usually through, we call them CDFI, or community development financial institutions that have alternative lending. And then commercial real estate, if you're buying property, and then equipment and inventory financing. So getting into it a little bit deeper here. For the small business loans, typically at this stage in most of your businesses, you will need to make a personal guarantee on that, which means you are saying personally, I'm going to pay this back if my business cannot. That's not a deal breaker. We all start there. I did that as well. At some point, and I'll get into business credit scores in a couple of slides, you are going to try to build up your business credit score so that your business can apply for the loan or the line of credit or the credit card, and it is not going against your personal credit rating. Because that's the hard part, right? You take out a loan, you're having trouble paying it back, and now your own personal credit score starts to sink because your business isn't paying it. So it's something that we all face, but not insurmountable. The SBA offers, let me go back a second. For the small business loans, utilize a bank that you already have a relationship with. And if you're, with one of the bigger banks like Wells Fargo, Bank of America, you can still have a relationship with someone at your local branch. And I recommend you do, because they'll go to help you out a little bit more than if you just applied online. They understand your business, they've seen you in there, they know you're working hard, and so they might be able to help you navigate the channels a little bit better. So I always highly recommend having a relationship with a banker in your local branch. SBA loans. So SBA loans are great, as I mentioned. They're low interest rate. They can be up to 30 years. Many of you might have had the PPP loan way back during the pandemic, or the EIDL loans. SBAs, they're great. They're a little bit cumbersome to get. There's a lot of paperwork involved, and it can be a very slow process. And also, if you're borrowing more than $250,000 for your business, they will require that you have collateral, and that's typically your home for most small business owners. So again, it can be done. Great rates. I think I think my EIDL loan was at like 3%. So, it's definitely a great alternative. Lines of credit. I love lines of credit. I love lines of credit. You need to apply for it when you don't need it. So when your business is doing well, you've got revenue and net profit for a few years, apply for the line of credit, and then you can use it when you need it. So lines of credit they'll give you, I don't know, $50,000 line of credit. You don't take it out. It's sitting there kind of like a credit card, and you use it when you might need to, and then you pay it back. And it's great because it's not like taking a whole loan out and now you have to pay it back, and you might not have used all the money for something, and now you took out too much of a loan and you get concerned about the payback. You're only taking what you need, you pay it back, it reinstates to whatever the max was, the $50,000, and then you can tap into it again when you need it down the road. Again, great time to do it is when you are net positive in your business, and you have revenue, you have not just revenue, but profit for 2 or 3 years, and your projections are looking really good that way too. Banks love that. They never want to loan to someone who has a loss, because then they're putting what they consider good money after bad. Microloans you can get, as I mentioned, through the community development financial institutions. They can be $5,000. Sometimes they're interest free, sometimes they're low interest. There's a lower barrier to entry there. And you can find CDFIs if you go onto SBA.gov, and you can search in there for where your local community development financial institution might be. And they are very, very small business minded. That's what they exist for. They have alternative financing type things that you can take advantage of. Commercial real estate, of course, if you're buying the building that you're occupying right now, that of course is like any real estate transaction. And then equipment and inventory financing, especially on the equipment side, if you're producing something and you need to purchase large scale equipment for that, those vendors often have financing terms for you. One that I did not put in here right here because I was going to stick it under kind of micro loans was Kiva, Kiva is also it's a nonprofit that issues interest-free loans, and they are crowd-funded. So it's kind of interesting. If you go to kiva.com, it's really interesting the way they do it. They you apply for a small loan, $5,000, $15,000, and then people crowdfund it and loan you the money at like $25, $50, $100 at a time, but they fund your loan and then you pay it back interest free. And it's Kiva's multinational, it's worldwide. They are focused on women and women in areas that might need a little bit more support than others and don't have the resources available. So that's a really cool one too. So getting into business credit scores. All of us starting our business, me included, we start with our own, we apply for a business credit card, but we put down our own social security number, right? And then that business credit card, you pay through the business, but really it's going against your personal credit. And it takes a little bit to get started with business credit, but you can do it. And there are a couple of ways to do this. It's super important to separate, not only for credit and debt purposes, but for business purposes, your personal stuff from your business stuff. If you combine them, it becomes very confusing what is personal and what is business. If you combine them, it becomes confusing what someone can latch onto if you fall behind on a payment or that you get a lawsuit. You want to keep that really separate. And trade credit reporting helps you do that because now you're applying for something under your business line of your business credit score. It also, like I said, it protects your personal credit. And you can try to do that by starting with the bank that you work with right now and applying for a business credit card using the EIN for your business and not your personal social security number. You can set up with Dun & Bradstreet. And normally you think, God, that's only for huge businesses, right? No, it's really not. You can set up, you can register, it's free. Don't ever let anybody make you pay to register for Dun & Bradstreet or FICO or Experian. They're all free. And you go and you register, you put in your business information. And if you have vendors that, bill you and you pay them back, like a normal accounts payable, they might start putting in information there, saying, yes, this business pays on time. You start building the credit that way. You can upload your financial statements so D&B gets an idea of what your business looks like and the revenue looks like, the number of employees. It starts to legitimize your business a bit more. And that's really great for when you're going for business debt. They'll start to look at this and go, well, how serious is this business? Are they on D&B? Same thing goes for the FICO, small business, and the Experian and Telescore. As you're building this credit just for the business, it'll start to show up on those. And I can't say this enough, as often as you can, go under your EIN, your employer identification number, rather than your social security number. Okay, that will help you establish that very separate business from personal. I'm going to get into a little bit of the what to stay away from, and these make me so nervous. Invoice factoring and financing. So this is an interesting one. I don't see it that often, but when I see it, it's not good. I'm going to say it that way. What invoice factoring and financing is that if you have accounts receivable, so you invoice your customer or your client and then they pay you later. So it's not for people who are e-commerce, right? Because that's totally separate. But if you invoice and you have an accounts receivable of, I've got $50,000 of accounts receivable that people owe me, and I want to tap into that 50,000 now because they're taking too long to pay. It sounds like a great idea, but what the pitfalls here are, if you factor your invoices, that means you just take them and you sell them off to another company. Now your customers are paying that other company and they know it. And so instead of someone paying DK East, they're paying Invoice Factoring LLC. And so they can see that they are paying that. And what happens is the factoring company will say, okay, on that $50,000, we'll give you 40 right now. And if and when your customers pay, we will pay off that $40,000, and if they pay us all the 50, we're going to keep a little chunk of that extra $10,000. So you're never going to get the whole 50. You're going to get maybe, 85% of it, maybe 80% of it. The hard part is, again, your customers are going to know that they're paying someone other than you. For the invoice financing, it's a little bit different. It is also a little bit very, cumbersome. And in that, they would give you the money. The financing company would give you the money for those outstanding invoices. The customers wouldn't pay you, but when you get revenue in, they're going to just take it right off the top. They're going to ACH debit your account, your bank account, and just go ahead and take their share of that invoice each time. So that again becomes really, really tricky. Revenue-based loans. And these are the kind where you're like, okay, I expect to bring in $10,000 this month. And they say, great. When you get that, you're going to pay us 9 of that to pay back your loan. So you borrow $50,000 and you say every month we're expecting to make 10. They're going to take their portion regardless of what expenses you have. So it is gross revenue. It is top line revenue that they are targeting. And obviously the pitfall there is if they say we want 9 of that every month and your expenses are 8 or 5 or anything more than 1, you're going to be in a bad spot. So really important that you don't do those. And then finally, the short-term or weekly loans, I've seen these happen as well, where it's you pay back on a weekly basis. And again, they just ACH debit right out of your account. The interest rate on these on the forefront might look like, oh, it's only 1.5% or 2%, but that's per week. And it compounds really quickly. And you get to a point where you can no longer make the payments because the interest is going to end up being as much as the principal was initially. I'm going to tackle all the questions at the end. Okay. Desiree mentioned predatory lending, and this one gets me. This is scary stuff. So, and they often target women and people of color in these because we just look like we are targets for this kind of stuff. Predatory lending is usury rates, super high interest rates that will, and they frame it as alternative financing. You can't get something through your bank because you don't have the credit right now. Your credit card might be maxed out, and you see this thing saying, okay, you know what? No credit check. We'll give you the money. It's all good. You might have seen these at the kind of used car lots where you end up paying a 25% interest rate on a car. You end up paying $15,000 for a $5,000 car. This is similar. And the interest rates are high. There are origination fees that you might not be thinking of where you say, okay, I'm going to take a $10,000 loan. And they say, great, you're going to net $8,000 because we're going to take 2 right off the top. It could be that weekly, you need to pay it back weekly. It could be, and I have an ex-mother-in-law who I went through this with, who, if you don't pay this loan back, even this small amount loan, there's a term in there or condition in there that says, if you don't pay it back by this date in full, either A, there's a huge balloon payment, or B, we own your business. And that's the scariest one, is if you don't pay back this loan, we get full ownership of your business, even if your business is worth far more than what you borrowed. So you need to read through that fine print really, really closely. And if you have an attorney or a close friend who operates in that space, to have them review it too. Have your CPA who does your taxes look at it for you and go through and make sure you really understand. They always look super good. Like, I can get this quick, and it's always in a time where you are panicking and you're thinking, I need this money to buy, my raw materials, to do my inventory, to sell, to fulfill this contract that I have with Whole Foods, Target, Walmart, whatever. And you're not going to get that revenue in to pay back that loan in a timely basis, and this is going to end up being a huge issue. So make sure that you are not, you're reading that, you're not pressured to sign quickly if they're starting to pressure you, saying, do this by the end of today or this loan goes away. No bank is going to tell you that. No reputable lender is going to tell you that. Just be super, super careful on those. I can't tell you enough on that. So let's say you have decided, okay, I'm going to get a loan. I'm going to go through the SBA or my bank or the CDFI. I'm feeling good about it. What are they going to ask me for? And I normally don't put everything on a slide. I did hear if you want to screenshot this just so you can, okay, down the road, I think I'm going to look at this in 25. These are things you're going to need. So you might want to screenshot it just to keep it for yourself. Business plan is, what is your business going to do now and in the future? And it's everything from the executive summary of the overall, what does your business do? Who are the people? Are there other owners in this? What are my current financials? What are my projections? Why am I a good market fit? Why am I different from other businesses? There are some cool business planning softwares out there. LivePlan is one of them that you can go. I think there's Business Plan is actually under LivePlan, but you can go in and do up a business plan if you don't have one already. They're going to ask for your business license. So if you're operating out of your home, make sure that you are licensed in your locality. That one got me originally 6 or 7 years ago when I applied for a line of credit. I've been operating out of my home, and I needed the county's business license and the city business license to get the line of credit that I wanted. The financials, and this is important. They do not want financials in Excel. They don't want financials in, in Word. You want a profit and loss, a balance sheet, and a cash flow statement. And this isn't the workshop for what all those things are, but they're all very important. The profit and loss and the balance sheet. Profit and loss is what has happened in your business over a period of time. The balance sheet is a snapshot in time as of today, as of 12/31, whatever the date is. And the cash flow statement is that it shows the difference. Like, if you ever wondered why at the end of the year your net income is not what's sitting in your bank account, cash flow statement will show you exactly how cash came in and cash went out, including things like credit card payments and loan payments that won't show up on your P&L. Projections up to 3 years. Do your best. Projections are 100% inherently wrong. If they were right, there would be a ton of us sitting in Vegas all the time doing financial projections. But do your best, and do your best to make it look like it's going to be a healthy business. You might be required to do personal financial statements and personal and business tax returns. However your business is organized, articles of incorporation, organization, you're an LLC, S Corp, however it is, your bylaws, your operating agreements, those you will need as part of your financial package for this. And then, of course, if you have any building leases or other, other major debt already, they're going to want to know what those things are too. And I'm getting through this in like half an hour. So I had 45 minutes, so it gives us lots of time. And I see the messages popping up there. So I'm assuming you guys have a ton of questions. How do you decide on whether you're going to do this and which vehicle of debt you're going to take? first of all, on whether you're going to do this, take on debt when you know that you are building a business that can pay it back. Don't take on debt we all struggle with this, right? We take on debt when we are struggling with the business and we need to pay it. We need to cash inflow in order to make it work. You have to make sure that when you take on that debt, you can pay it back, and you can pay it back on time. And the projections that you're doing for that last slide that I showed, that's exactly what you're showing the bank that you can do, because they want you to pay it back. They don't want you to default on this. They don't want to ruin your business. That's not what they're in business for. They're in business to make interest on the loan that you just took. And you need to make sure that when you do and work with your CPA or your bookkeeper or your controller or whoever, or yourself, if you're just good at numbers, just lay out for the next period of time, however long that loan is for, your cash in and your cash out on a monthly basis, and put that line item in of, I have to pay $1,000 a month back, or $500 or whatever it is. Can I still do that? And make sure that you can. Do not enter into debt when you are in a kind of a downward trend and you're just grasping for what can I get to get me through this. You need to have that hockey stick of revenue and profit going up when you take this money in. And again, the banks don't want to see you fail on this. That looks bad for them. It feels bad for you. They want you to pay it back. So what are you looking at? You're going to look at the interest rate. You're going to look at how long it is. You're going to look at the terms for it. Is there a 5-year and then a big balloon payment? Is it over 10 years? Is it 3 years? What happens if you default on it? What does that process look like if you happen to? We're just going to assume everybody on this call is never going to do that, but just look at the detail there of what happens with this particular loan if I fall behind. Can I renegotiate the terms? That kind of thing. Check the fees. Sometimes it looks like there's a real low, 2.5% interest rate, but they slap on a really big origination fee. If you have a mortgage, you might have seen this happen in your own home mortgage, kind of works the same way. You could buy down an interest rate and pay more money up front for a lower rate going forward. Sometimes that's available on these, but you want to make sure that you're not entering into something where immediately you're losing thousands of dollars in fees, processing, application, origination type fees. And then finally, the funding speed. How fast do you need this money, and how fast can they get you the money? I mentioned SBA, fantastic, low rates, long terms, solid, but it takes a while. It can take several months to get an SBA loan to go through, especially if you're looking at one that requires collateral, like over $250,000. Those are going to take a long time back and forth with whoever your contact is at the SBA, the lender that they set you up with. So see what kind of funding speed there is. Don't fault on the side of we'll get you this by the end of today at a 45% interest rate, but consider I can't wait necessarily 3, 4, 5 months for this to happen. Okay, so you've got the debt, all that went great, everything was going fine, something crazy like, I don't know, a pandemic hit, and now you're struggling a bit. So what can you do about that? You can try to renegotiate the terms. If it's with a bank, if it's your local bank and you have a relationship, try to see if you can go in and say, look, I'm struggling with this. Can we refinance this loan at a lower rate, maybe a longer term? What can we do? Talk to your banker and say, what can we do? Don't be embarrassed about this. Again, they don't want to see you fail. They want it paid back also. And sometimes there will be room for you to navigate that a little bit. At a very minimum, and no pun intended, but at a very minimum, pay the minimum if that's all you can pay. Just at least get that part done. If it's on like a credit card or something like that, where you don't have to pay like the full amount, you don't want a long term, that kind of a thing, but pay the minimum. if that's all you can pay. Um, Evaluate the terms with your own customers. So if you have customers that you have 30-day terms with and they're paying you at 45, 60 days, go back around and collect that debt that they owe you so that you can pay your debt. And if you've got 45 or 60-day terms with some customers right now, maybe you can move it back to 30 and you get paid quicker so you can pay your debt quicker. Look to your own expenses, of course. If you are struggling, look to what can you cut. The last thing we want to cut is people, of course, but a lot of you on this call might be solopreneurs. So what other things can you cut? Or do you have software you're not using? Do you have subscriptions you're not using? Are you utilizing your travel, meals, and entertainment a little bit more than you should? Can you cut back on that? So go through and look at your expenses and see, where can I trim and take that money and pay the debt back? And this is an interesting one, because often we're told, and it's kind of more of a mental game here. Often we're told, which kind of makes sense, pay off the high interest rate balances first, because there's a lot of interest there, right? But from kind of a mind shift piece of it, it often helps to pay off, if you have a credit card and a line of credit and a regular bank loan, or several credit cards, it sometimes helps to pay off the lower balance first, because then that's done, right? Okay, good. Whew, that one's done. And then don't re-up and use that card again. But whatever payment you were using for that card, slide it over to the next one, and then pay down that lowest one. That one's finished, and slide both those payments to the third one. And it's kind of, it gives you a sense of accomplishment, instead of feeling like you're constantly paying multiple different, debts and credit cards, and it gets overwhelming and you don't really remember like which one has a balance. This helps you just remove it. And the biggest piece of it is, don't start reusing that credit card again. Just put it off to the side, leave it, and then don't necessarily close it, because that might hurt your credit rating. But move it off to the side. You don't have to worry about it anymore. And it helps you get through the paying it off. The other, of course, school of thought is paying the highest interest rate ones off first, which is also good. But if you're struggling with several, it helps to go through those smaller balances and get them out of there. And that's my cue. I did finish like a couple minutes early, so lots of time for questions and answers. And I'm going to just throw my last slide up here too, if that's okay, Desiree. Is that okay that I throw that up there?
Yes, that's fine.
Okay, cool. So if you're sitting there going, oh, those financial statements is like, what the heck? I also have a digital course that you can screenshot this. I'm giving you guys 50% off the fee for the next 30 days. This goes through every single financial statement, how to budget, how to forecast your cash, and how to use those financial statements to make sound business decisions that are not from the gut, but are validated by your financial data. So I'm going to stop sharing, and then I will let Desiree lead us through questions.
Hey. All right, Dorothy, thank you so much. We've got a bunch of questions, but I want to start with one, just clarifying something that you said early on in your presentation. Is the line of credit for your business against the business's credit score or your personal credit score?
That will differ depending on how far along your business is. Ideally, you'll apply for it under the EIN of your business. And I would do that. And then potentially they might require that you have a personal guarantee along with it. But when possible, the cat's back. When it's possible, do it under your EIN, because that sets up your business for having a business credit score.
Great. And we have a few credit score questions here, actually. One of which is kind of the opposite. Does your business credit score affect your personal score?
No, it does not. The two don't affect each other, except for when you're personally guaranteeing something with your business. So
Okay,
that's like the key point. Like your business can go south, and if you have everything under your business credit score, your personal score will not suffer.
great. And then as far as monitoring those scores, you mentioned Dun& and Bradstreet, FICO Small Business Reporting, Experian. Which of those is the most used by banks? And should a business be registered with all three?
Yes, definitely. Once you have a FICO and Experian are kind of like your personal ones. Like once you have credit, it will show up there. Dun and Bradstreet, you need to register for. But I do have a note here for, and the banks do use it. The banks will use the FICO and they'll use Experian. And then, if you're taking out like an SBA loan, they do have a minimum score, which is like technically 155. It goes from 0 to 300. But they will be looking at that. And once you have started using, your business credit, it will show up there. But absolutely go in and start being active in those spaces, because that's also where you find, along with your personal FICO and Experian score, if something is, if someone has applied for something under your business, if there's fraud, you're only going to find that if you're kind of active and looking into that.
That's great advice. And I mean, if you had to say, how often should someone be checking their own reports?
At least once a year, kind of like your personal one, like at least once a year. Those, of us who have like a Credit Karma or whatever, we pop up on there more often than that. Better quarterly. I wouldn't go like you have to go look into it every month unless you start seeing some weird stuff, and then you might want to, check in on it more often.
Great. And shifting to the specific debt products, there are lots of vendors who offer loans. And I know that you did touch on this, but for example, Shopify Capital loans, um, they seem to come with high interest, but have the terms where the founder only pays when they sell inventory. And how should a young business approach these kinds of products?
Yeah, those are kind of along the lines of those revenue ones I was talking about earlier,
Mhm.
because Shopify will come and take their piece of it off the top, and then kind of like what their fees are, right? So you sell something for $100, they take their $5, and then they'll take their percentage of the loan also. So you'll see lower revenue in your books. So you have to be careful that if you're taking out something like that, the payback is now completely out of your hands. So you can't push it off and say, I'm going to pay payroll first, and then I'm going to pay back this loan. They're going to get paid first, and then what's left is for your business expenses. So you just want to be careful that, remember I was mentioning, like, look at cash in, cash out, and the loan cash out part to make sure that you can pay it back and still have money remaining to actually run your business. So that's the key point there.
Right. We don't want anyone skipping payroll. Um,
No,
yes,
and
that
payroll includes you too.
yes,
So
I
as a
was just
business owner, payroll includes you.
okay. And so, does the legal entity of a business have any effect on the kind of loans a founder can get? So, let's say, is there a difference between what an LLC is able to access versus a sole proprietorship or an S corp?
Yeah, absolutely. As a sole proprietorship, you will only be able to get it under your personal, because your business is listed under your social security number. It's a disregarded entity on your tax return. It's just going under as business income, Schedule C. If you're doing an LLC, S corp, C corp, depending on how you have that set up, with the IRS and all, those would go more likely go under as a business credit. So, especially if you're an LLC slash S corp, now you're an actual entity that's filing an 1120 and tax return, and it's separate, and it's not. They call it a disregarded entity when it just assumes that it's you, just extended. So it is easier to get business debt and credit when you have it set up as an actual business entity and not as a sole proprietorship.
Great advice. All right. And so back to the
Oh,
actually we have
sorry.
a clarifying question from our earlier discussion. Can you explain what you mean by personally guaranteeing something within your business?
Yeah, absolutely. Personal guarantee is when you have said that I will say I have DK East Associates has taken out a loan for $10,000. We've gone through some rough times. I'm going to knock on wood that this doesn't go into the universe. And DK East can no longer pay that back. I, Dorothy Kolb, have personally guaranteed that, which means now I have to pay that back. And if I personally don't pay it back, they can come after me for, for default. It goes against my personal credit score. If it's something where, like I mentioned, the SBA loans for over 250, if you default on that, yes, they can come take your house if you put your house down as collateral as part of the personal guarantee. So it kind of pierces that corporate veil and says, okay, if the business can't pay, you are saying that you will.
Right. Oh, okay. Great to know, and also a little bit frightening.
A
Uh,
little bit frightening.
okay, so hopefully that is not the case with anyone on today. All right. We had someone else here today who was told that their business is actually so high risk that they don't really qualify for loans. And so, are there debt products that they can look into, or really can they only rely on things like bootstrapping or grants or other kinds of funding?
Yeah, so I work in the cannabis space too, so I'm used to this kind of a question. And often the CDFIs I mentioned, the community development financial institutions, will help in this situation because they are alternative financing. So I would suggest looking into that also. And then something like a Kiva where they crowdfund your loan. They're not necessarily, as long as they have, you know, funders who will go look at it and say, yeah, I'll give $100 to that. Then you can sometimes go through that way. Um, Otherwise, yeah, it becomes more of a bootstrapping personal loan. You could take out a personal loan for yourself and then contribute that to your business as an owner contribution and turn the funds over. The business would pay you, you would pay the loan back. Um, that's yeah, those are the kind of, if you're being told that it's a little too high risk now, or alternatively is take a look at what is so high risk in your business right now and can you correct that. Is it the industry space, or is it how you're running the business right now? Is it because you've been at a net loss for a number of years and that's why it's considered high risk? Like, see what you can do to kind of feel out what is the high risk part and can you lower that risk.
And in doing that, would that be about calling up, let's say, the bank that rejected your loan application, or is that a conversation to have with your bookkeeper or someone else on your
It
team?
is both. I think to dive in and find out, from whoever, because normally they'll send you something that says your loan was, denied, and here's why. Here's the, 5, 10 reasons why your credit score was too low. You don't have enough revenue. You haven't been in business long enough. They'll give you those, and they're required to give you those, especially on consumer loans, which, you know, um, but they do it on business loans as well. But I would find out from your lender, why that happened, and then sit down and go, okay, how can we eliminate some of these issues, and then circle back for this in 6 months or a year.
Um, so we have, I think, a few people who fall into the category of their businesses are in the early stages, and they don't have a lot of personal assets. And so a great example is someone shared that they and their co-founder are both recent grads with student loans, and have been struggling to get loans because they do have zero revenue. They were, of course, able to raise some money, about $6,000, and they have a personal line of credit of $5,000 working on grants. But what are their options for microloans to do product development and manufacturing to secure that manufacturing contract that will then enable them to have revenue above $0?
Yeah, we want revenue above $0.
Yeah.
Most, if not all, states have programs, like especially in Maryland here, because we're like all about entrepreneurship and clean energy and all that kind of stuff. But many states have a program within the state where they have an accelerator or what's the other one? Not incubators and things like that, where you can go, especially if you're operating in more of the tech space. And so I would suggest looking at what is available in your state to say, okay, what can I have? They're like not Y Combinator, because you need to be a lot further along for that. But there are, like, look into what is available in this tech space or whatever your space is, as a new business, as an incubator, as an accelerator that can help, because it could be either they have access to funding, borrowing, or they have access to maybe angel investors that won't take 50% of your business, that will help you along. Angel investors are great because if they come in and give you a certain amount, they might own 10%, or they do a convertible debt, which is, it's a debt now, but if you reach this point in your business, it will become that we own part of it. That's kind of an interesting one on it too. But they also come with knowledge. And if you're going to look at someone who's investing in your business in some way other than a bank loan, have them bring more than a check. Have them bring, I've got this connection, I've got this network, I've got these resources. Here's how I can help you. Watch Shark Tank and see, when they come, like, I'll give you the money, but what I'm also going to give you is all my marketing team, that kind of thing. So that can be super helpful.
Yeah, that's great. Those resources that you maybe can't quite put a price on can
Yeah.
also move the business forward. Uh, so to get kind of into the brass tacks of what how people can plan for their debt, how can a founder actually say, okay, I'm looking into this debt product. How can they then calculate what that monthly payment will be so that they can budget appropriately?
Well, you can get the monthly payment from your lender. You can say, okay, so this is it, and they will tell you, $10,000 loan, 5% interest over X, however many months. This is what your payment's going to be every month. And remember, I was talking about that, and I go like this all the time because I'm a spreadsheet person, right? So I have like columns and I just see them in my head. But um, you can, but lay out like every month, this is what my loan payment is going to be. It's going to be $1,500 a month. Here's my revenue, my cash in revenue. Here's my cash out expenses, and anything else, distributions. Here's the thing, because if you're looking only at your P&L, owner distributions won't show up on your profit and loss statement. And so you want to just look at straight cash in and cash out. I get me this much in cash. I pay this much in payroll and expenses and my owner distribution. This is how much I have left, and this much of it is going to go to the loan. And then make sure you're not under, right? You don't want that number to go negative. You would preferably want that number to still be a nice positive, because you want to continue to build up your cash reserve as you're going along, so that you don't have to always borrow, so that you're putting money away for future.
So we talked about looking at interest rates and origination fees, but if do you have any additional high-level advice for business owners that are evaluating the kind of business credit card that's right for them?
Yeah, there's a whole bunch of them out there, right? I mean, if you're someone who travels a lot, and you want to get, those, I mean, there's just tons, right? So there's cash rewards cards, there's travel rewards cards, there are cards that, like at American Express, that you can build up your points and buy other gift cards and things like that. So take a look at, ideally, what would I want to get out of this? Like, I want the cash rewards card at the end of the day. So if I spend 100,000, well, $1,000, I get $100 back in cash rewards. Great. Or is it more important, I travel a lot and I would like to build up my miles on United or Delta. And I want to use my business to do that so that I can fly for free when I go, or I can upgrade to first class when I go. So take a look at what is important to you as a perk and then look for those credit cards because there are ones under all those things. So you can, and there are ones that are 0% interest balance transfer or 0% interest for the first 12 months. So that might be something that is worth more to you than earning rewards.
Great advice. Um, okay, and this is a little bit more on the end of getting into trouble, perhaps with the debt products that you have selected. We had someone ask if you would ever consider a debt forgiveness program if you've maxed out personal lines of credit, or does that simply mean it's time to file for bankruptcy?
Oh gosh, yeah, I would not. Yeah, I had a prior business that filed for bankruptcy years ago with my ex-husband. I have to throw that in there. um, but that bankruptcy, business bankruptcy. Okay, let me separate this out. If you have adequately separated your personal stuff, your personal credit from your business credit, if you file bankruptcy under your business, it won't hurt your personal. Far too often, though, for those of us who have smaller businesses or early on, it's very commingled, right? And so if you have, personally guaranteed this and the business credit card is actually under your social security number, if you file for bankruptcy under your business, it's going to mess up your personal. So you have to really look at that closely. I have no issue with debt forgiveness, consolidation type things. They can get you out of major jams. Um, it might hurt your credit for a little while because the credit companies are looking at it like, well, you couldn't pay back those other ones, but it might get you out of the hole. And in a year or two, you can start up again with getting credit cards again or loans or whatever. But if you can work through some kind of a renegotiation or consolidation or debt forgiveness and get yourself out without filing bankruptcy, that's great.
Yes, yes, thank you. Um, I believe I saw a question come in earlier about what are what's kind of that sweet spot for rates whether you're looking at a loan or a business credit card.
Well, credit cards are always going to be high, right? Unless you find one that has, like I said, the zero balance transfers are great as long as you pay it off before that time period ends. It really comes down to, I mean, because the interest rates are fluctuating, they rolled them back again, but who knows, the new administration, what happens with all that. Um, but it really ends up like you were mentioning before, can I pay this back? Really look at it and go, okay, what is my monthly? I think I saw notes on here before. Somebody said there are loan calculators out there, right? Yeah, there are loan calculators on the web. You can just go in and say, I'm going to borrow this much. This is how much interest I think the interest percentage is going to be. What does my payment look like? I would do that and really base it on what can you pay back and try as hard as you can to stay away from the high interest. But if you're early on and you don't have that credit built up, it's more likely that you'll have higher interest rates because you haven't built that credit up yet. But it all comes down to, can I pay this back? So go online, get those interest rate loan calculators and say, if I borrowed this much at this percentage, what would that be? At this percentage, what would that be? Oh shoot, yeah, that's a big difference. Or it might not be.
Okay, so it's sounding like it all depends on how much you're bringing in, how old your business is, and less of, being able to say this is a solid number of for interest rates. Is that right?
Yeah, because it's going to vary. It is
Mhm.
definitely going to vary based on your credit worthiness, based on what time of year it is, based on whether or not you're collateralizing it, putting your house up on it or some other equipment or something like that, and how long a term it's going to be. All these factors come into it, and all can be used to negotiate the rate a little bit better. But it all comes down to really, can you pay it back?
Right. Uh, okay, and so I think this applies to several people who are on with us today. let's say they run a business that works with clients that do typically have really long payment terms. So let's say, or rather are slow to pay. So government entities.
Yeah.
But they really want to get capital from a bank. How do they explain these long payment terms when they have the business with negative cash flow because they are waiting to be paid? Is there a financial story that they can tell to help them understand that revenue trend, or do they just have to explore
Yeah.
the options? Yeah.
I'm all in favor of narrative around financial information and not just the numbers alone. So if you have a history of, I work with, and it's some of the big box stores too, right? So the Targets and Walmarts have really long, 120-day payment terms. And the government, yes, I've worked with the government too, where you're waiting, forever. Um, and I think if you can show that you have contracts in place for X amount over the next however year or whatever, and you can show that they consistently pay, they just pay later, that is a narrative you can work in. Look, this is a good customer of ours. They always pay, they just pay little bit longer than because of the terms that we have, and show that it will continue in the future, not just like you know they've been paying taking very long to pay because they really don't want to work with us anymore type thing. I think you can work that into the narrative a little bit and show that, this is a consistent revenue stream that will continue.
Wonderful. Thank you. We are going to end there. Dorothy, thank you so much for your time.